Okay, so for part two of this finance review, let's see if we can pull this up and hang on just a second. Okay. All right, so to continue, and again, we're not teaching the finance course here, so we're not going to go into depth on a lot of this, but this is by virtue of review. We talked in part one a little bit about finance and so forth, and some of the theories that we need to be conversant with, including net present value and such. And we talked a little bit about risk, the uncertainty of return and required return based on risk and so forth. And we have a different way sometimes of looking at risk. We have a different way of measuring risk. One of the things that we look at is standard deviation, which we remember back from several other courses. Many of us, probably most of us, took statistics either with Dr. Canori or one of the other faculty. And so we're familiar with standard deviation and what that's about. And, again, standard deviation measures, dispersion around a mean or around some kind of expected outcome and so forth. And so when we look at standard deviation in terms of probability of outcome and so forth, and we do what some refer to as sensitivity analysis, which is the idea of an optimistic view, a pessimistic view, and then something more centered that is perhaps a most likely outcome. And we apply that to some of the things we're looking at. So we take two assets, asset A and asset B, and we have the probability of outcome and so forth. So again, asset A, we might have a most likely outcome of 50% likelihood of 15%, and the weighted value, of course, being 50%. The probability of outcome times the outcome. So 50% of 15% or 7.5 is probably the most likely outcome. Now, could it be worse than that? Yeah, pessimistically, it could be 3.25%. Optimistically, well, again, it could be something greater than that. And excuse me, let me just take, okay. So optimistic view, 25% of 17%. So in other words, the most likely outcome is 15%, but we add the weighting factors to it and we get these results. And we come up with an expected return using this methodology of 15%. Well, asset B, okay, 25% times 7, 50% times 15. So 1.75 plus 7.5 plus 25% times 23%. So in other words, an expected return of potentially 23%, but there's only a 25% likelihood that that would occur. And again, weight times the outcome. So we end up with 15%. Well, what's the difference is, the question. And again, just looking at it, we could see that based on kind of a dispersion, if you will. Look what the swing is. The low end of 1.75, and of course, the high end of 7.5. But again, looking at the optimistic view, 1.75 versus 5.75. Well, this one 3.25. So in other words, the swing or the, in a sense, uncertainty or in a sense, variability is smaller here. The range of that is smaller than it seems here. So again, is that going to compel us to choose one versus another? Well, probably not, but it's likely that it's going to seek out the more risk-seeking versus risk-averse individual. Because if I really am unfriendly in terms of uncertainty of return, I don't like big movements, up to here, but possibly down to, I like it more confined, more restricted, a smaller range, if you will, and so forth. And then again, we look at the measure for standard deviation, small sigma, square root of the sum of the k minus k bars, in other words, the expected outcome or expected, and again, we did this with, the x variable. So, x minus expected x, or the difference between those two. So the sum of that squared times the probability and so forth. And so, we do the arithmetic, we get an outcome. And if we did it for both of the assets, we see that, look, the look at the range, if you will, 1.41 versus 5.66. So, um, it's not that it's just outcome driven. We've got the risk component too, and that becomes a big factor. But again, our concern in an MYOB environment is less to do with this per se. And again, we look back at some of these things and we see the long-term average annual returns of different categories, the benchmark of safety being the U.S. Treasury bill. And then if we look at standard deviation, we find that there is I guess you'd phrase it, a high positive correlation between standard deviation and the average annual return. So, risk versus return. And we're used to seeing this, so I'm not going to, plus or minus 3 standard deviations contains basically 99% of what we're likely to see in a normally distributed environment. We recall all of that. And again, 99%, 95%, 68%. So 1 sigma, 2 sigma, 3 sigma, plus or minus. We recall things like the coefficient of variation, remember R squared, and I'm not going to go through all of this, but this is some of the stuff that we would play with in terms of looking at risk and a portfolio and so on and so forth. And we do this in the finance course or courses. We see that these are perfectly positively correlated. These are perfectly negatively correlated. We remember those kinds of things. So again, we're not going to spend a lot of time doing this kind of stuff. One of the ways we look at a portfolio also, and again, remember, most of our financing comes through debt and equity. And when we start to talk about equity, we start developing an interest in something called the CAPM, the capital asset pricing model. And, if we look at the CAPM or we recall the CAPM, we're looking at the relationship between risk and the return of an asset. And again, there's more there than what we would need to look at, but our measure of risk was something called beta. And we said that looking at beta, the average annual return of the S&P 500, that slide is in here somewhere, but the average annual return of the S&P 500 is something like, 14%, depending on the, numbers that you use, the years that you would use. So if the long-term average annual return that you're using is a 10-year period, then, it'll give you one number. If you look back 20 years and you average, you'll have a slightly different number. The point being that market risk, when we speak in terms of market risk, which is said to have a beta of 1, we're looking at the proxy for market risk, which is the S&P 500. So in other words, a beta of 1 gives us, and again, the long-term average annual return being 14% gives us 14%. Okay. So if I'm taking market risk, something that has arguably a beta of 1, but the expected return is more around 9%, well, there's something wrong there, isn't there? because what we're arguing is that, again, a beta, over return, beta of 1 is market risk, and that ought to return, given the arithmetic, 14%. So we look at, well, there are other investments, long-term average annual return might give us 20%. Well, what's the risk? Well, if it's a beta approaching 2, well, just simple arithmetic would say, well, if a beta of 1, 14%, beta of 2, 20%, would kind of tell us I'm taking an awful lot more risk for marginally some amount of additional return. But seems like the rate of increase is higher, and that's what we're seeing here. Again, in the finance class, we would spend the time to do this. So again, capital asset pricing model is something that we would want to be pretty familiar with. And, the return, required return is basically the risk-free rate plus beta times the difference between K sub M, the expected return on a particular portfolio or a particular equity or something, but K sub M minus the risk-free rate. So again, 14% minus 3%. Okay, 11%. So beta times 11% plus the risk-free rate. So beta times what? Times this difference plus the risk-free rate is our required return. Example. Required return for Federal Express, assuming Federal Express, FedEx, has a beta of 1.25. Rate on T-bills is 5%. The expected return for the S&P 500 is 15%. So required return equals the risk-free rate. And these are arbitrary numbers. These numbers don't exist as we sit here today. Okay, T-bill, risk-free rate, beta of 1.25 times this difference. So in other words, 10%. 1.25 times 10% is what? 12.5 plus 5 is 17.5. So capital asset pricing model, that would be something we would spend some time with. And then, we would look at, debt, so on and so forth. And, looking at some of this, we get invariably back to the idea of NPV, and this is what we were speaking about the other day. And there are a lot of ways to characterize NPV, but basically what we're looking at is, and if you see this, cash flows sub t, in other words, at some period, sub t is time, t sub t would be time of the instant, or we could use the convention 0, and then cash flow period 1, period 2, period 3, or t plus 1, t plus 2, blah, blah, blah. So in other words, cash flows for a period divided by, so that's our numerator, the denominator is 1 plus k. Okay, this discount rate that we would use, the discounting vehicle, minus CF sub 0, minus the cash flow. So put differently, and this is why I said it the way I did, simply put, NPV is minus I. In other words, that's that CF sub 0, the cash flows, minus this cash flow. So minus I, minus the initial investment, minus whatever we're contemplating doing. We're going to spend, I don't know, $500,000 to build a new manufacturing facility. We're going to spend $250,000 to buy a new machine. We're going to, whatever that happens to be. That's your minus I. That's this cash flow at time 0. Because at time 0, that money goes out the door. It's a minus, right? It's not an inflow, it's an outflow. So minus I plus the present value of the sum of the future cash flows. So put differently, the sum of the cash flows times the present value interest factor. In other words, the now value of those flows, because it's not going to be the same year to year. You know, the now value of something 5 years down the road is less than today. And, you know, go back to the NPV discussion we have. So I simply reordered a bit. So basically it's minus I plus the present value of future cash flows. That's what NPV is. And that's probably a very good tool for us to use. I know we discussed this the other day, but basically the decision criteria is, and the easy one is, if the NPV is greater than 0, do the deal. If the NPV is less than 0, don't do the deal. And this is the confusion part. If the NPV is 0, do we do the deal or we don't do the deal? Well, the answer is we do the deal. We do any deal with an NPV of 0 or greater. Why? Because we're talking about the after-tax environment. We've accounted for our cost of capital. And then we have put simply, the tax deduction for the expenses and everything else. So that nets us a positive. So at the end of the day, a 0 or positive NPV, it's like somebody saying to you, hey, look, for each dollar you give me, I'm going to give you back $1.10. You're going to give me $1.10 for every buck I hand you. And we're not talking about the present value. You know, we're talking about, you know, now. Okay, over time, we would have to do the calculation, of course. But in other words, I give you $1, you give me $1.10. Well, how many of those bucks? I'd come up with every dollar I possibly could and hand them right over. That time equals 0, because you're going to give me basically 10 cents on every. Now, is it as simple as that? Oh, of course not, because there are the tax aspects to all of this stuff too. So, you know, passive income versus, you know, other. And so if I've got earned income, if I'm making 10 cents on every dollar, well, I've also got to pay taxes on that. So what are my taxes and what are the costs and blah, 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 blah. But in theory, anything with an NPV of 0 or greater, and we do the deal. And we have a couple of, you know, examples here. You know, Bennett Company table data, I guess, is one of the examples here you could use. Firm has a 10% cost of capital, so that's our K. Based on the given cash flows and the cost of capital, aka the required return, because they are synonymous, the NPV can be calculated as shown, and it gives you all this stuff here. Again, the finance course, we would actually do this, but conceptually, I want you to understand these things. And another example, ABC company, so on and so forth. There is something here you will, excuse me, recall with fondness. Remember internal rate of return and then MIRR, modified internal rate of return? Remember that? I can see you all shaking your head saying, what the heck is that? Stuff like that is helpful to you in terms of investments as well, but I will suggest to you that in terms of a tool on which I would use, whether I use an internal rate of return, a modified internal rate of return, or NPV, I would be using NPV. We recall weighted average cost of capital, and this is where we introduce that debt piece, the after-tax cost of debt. Now, their convention is, you know, for the CAPM, you know, K sub, you know, M or R or whatever, and you know, K sub I. You know, I use K sub D for cost of debt, K sub E for cost of equity in terms of the CAPM, and here are the debt side of it. And so I bring those conventions into weighted average cost of capital. And basically what we're saying is, in terms of, you know, two ways to raise money, right? Through debt and through equity. So I use the CAPM, excuse me, CAPM as a tool for the equity side of the argument. And I use K sub D, although their convention is K sub I. I use K sub D, you know, for the debt side of the argument, because, you know, look, the debt's K sub D, our cost of borrowing, you know, debt and equity. and our cost of, the equity input. So after-tax cost of debt, I would be using K sub D equals yield to maturity times 1 minus T. So after-tax cost of debt, assuming the company in the previous example is in the 40% tax bracket, okay, 1 minus T. Okay, K sub, well, D, cost of debt, all right, 9.4, and where do we get this? Well, that's what we're saying here. 9.45% minus, so yield to maturity, 9.45%, minus 1 minus T, 40% tax bracket. So this times, so what we're saying is 60% of this, right? 1 minus 40, 60% times this, 5.67%. So after-tax cost of debt using, now debt is always cheaper than equity until the first dollar where it's not. And I know, what does that mean? Well, you go to the bank and you say, look, I need to borrow $1 million. And, the banker says, all right, based on, the 5 C's, blah, 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 all this baloney. Okay, going to cost you 4%, $1 million, 4%, some period of time. Got it. Business moving along. You think the solution is to expand even further. You go to the bank, say, look, I need another $1 million. Well, the bank sits back. Now, it's not, necessarily a bank. I'm using that as an example, but your source of funding, whatever institution, whatever fund, whatever investment club, whatever it is. I'm saying bank. All right. Well, you already got $1 million at 4%. All right. So we'll give you another $1 million. It's going to be 4.25%. And everything's running along smooth. You go back for a third time. And now they're sitting back and they're looking at some of the accounting ratios, which we'll talk about for the next class, the review on accounting. But we're sitting back saying, hey, wait a minute. Okay, so $1 million, $2 million, $3 million. Now we're looking at some of the ratios, debt to equity, you get the idea. So this time you say, well, okay, I'll give you this third $1 million, but it's going to be about 6.5%. Why? Well, because of some of the things we've been talking about, the risk, the uncertainty of return. Now we start to inject some of the accounting relationships and so forth. So this is how some of this stuff, really works. And, when we do, K sub E, so K sub E, the risk-free rate plus beta times the difference between market and the risk-free rate. So again, if the S&P 500 is 14% and the risk-free rate were 4%, 14 minus 4 is 10, whatever the beta is, so if the beta were 1, if the beta were 1.25, whatever it is, so whatever that arithmetic turns out to be plus the risk-free rate becomes our K sub E, our cost of equity. So we have cost of debt, we have cost of equity. There are different ways, and where we look at, dividend income, dividend growth, price income, price growth, and so forth. But this is one of the more common conventions to use, as opposed to just market price or return on that, and so forth. So, 3-month T-bill, 5%. Market risk premium is 9%. The firm's beta is 1.20. Okay, so the market risk premium is 9%. Remember, beta, this was, KM minus risk-free rate. So the market risk premium, netting that out, is 9%. So 1.2 times 9 plus 5, 15.8%. Okay, K sub E. And then, we go on to other ways to look at this stuff. And the weighted average cost of capital is basically the weight of the debt, times that rate, weight of equity times that rate, and so forth. So we come up with a capital structure, weighted average cost of capital. weighted average. Some percentage is debt, presumably a lower rate. Some percentage of it is equity, presumably a higher rate. And we do the arithmetic or do the math, as Robert De Niro would say, and we end up with a weighted average cost of capital, as in this case, of 11.13%. Why is it important? Because we have to know our cost of, some people say cost of borrowing, but that implies the debt side. And maybe that's all we're doing. If we're a small startup, that may be realistic because, it's not like we're issuing stock like General Motors or something. But the weighted average cost of our cost of money, our cost of this commodity called money. So it helps us decide, hey, look, if I invest, $100,000 here, well, what's that $100,000 really going to cost me? Because nobody's lending you 100 grand for nothing. So there's some cost there. And then what about the inflows or what we expect to gain from making that decision? Well, it sounds an awful lot like NPV, doesn't it? All right. Well, I'm going to stop share. This is part 2 of what I wanted to go over. Now, again, I'm going to try and post these slides under, fair use. Don't want to get in any intellectual property issues. So as long as, it allows me to do that, then, those slides will be available. But you should have at least enough of an understanding of finance to understand time value of money concepts, how we arrive at an understanding of risk, how we arrive at an understanding of our cost of this commodity called money, these kinds of things. And hopefully you remember all of this or most of this from the finance courses. And if you haven't had enough finance yet, then, you will, and some of this will start to make a little more sense. And you'll certainly do a deeper dive then, or just, looking at it in a cursory fashion. But this is a big piece to, I think, managing any business, not just MYOB, but, MAB, managing any business. And we'll talk more about the accounting in the subsequent session. But hopefully this gives you a little bit of a perspective. And with that, I'll end this. And if you watch this part 2, having watched part 1, then hopefully it gets you at least to a point where you know where to look to review this kind of stuff. Have a great day, and we'll chat soon.